Okay, let's talk about bond prices and yields. Chapter 14 starts us off with some information on debt securities. Now we know debt, bond prices, credit, these are all interchangeable terms. We talk about the bond market, we talk about the credit markets, we talk about the debt markets. Very interchangeable, used often in common parlance in the financial industry, so you make sure you have those terms correct. We're going to talk about debt, fixed income securities, obviously types of bonds. This is right out of corporate finance, bond pricings and yield, the prices over time because the price changes over time as you near maturity. The impact of default and credit risk on bonds, of course, you want to get your money back. Bonds are basically a loan. Credit or a bond is a type of loan from one party to another. And then we're going to talk a little bit just at the end of credit default swaps and collateralized debt obligations. So bonds are the debt obligations of the issuers. We call them borrowers, and bondholders, which are the creditors. They have a face or par value. That is the principal repaid at maturity, typically $1,000. They use $1,000 increments to say, I own a bond. That means that you have a par value or a amount that was originally lent and is now owed of $1,000. And of course, we know the price changes. The minute you buy it, the price can change because the interest rates can change, or the risks can change, and other things can change as well. The coupon rate determines the interest payment. The coupon payments are paid semi-annually. Assume all coupon payments in this course are semi-annual, although you can get loans at other amounts of time, other terms. Let's just use 6 months in this course. And an indenture is a contract between the insurer and the bondholder that specifies the rate, maturity, and other things such as par value and so on. The bond indentures are basically the terms of the contract. So those are some words that we need to pay attention to here. And of course, there's different types of loans. Treasury bonds are money that has been borrowed by the U.S. Treasury. So if you buy a U.S. Treasury bond, you are loaning money to the U.S. government. Bonds and notes may be purchased directly. A note is 1 to 10. A bond is 10 to 30. And of course, Treasury bills are less than a year. The denomination can be as small as 100, but more common is 1,000, as they show here. And of course, the bid price, we say 108, which means 100 or 8/30 seconds, or $1,002.50. So the 100 is basically 1,000, and then we get some sort of fractional change in price. And of course, bonds, if they are under $1,000, would no longer be 100 plus something; it would be less than 100. And then we have different types of corporate bonds. We have callable bonds, convertible bonds, puttable bonds, floating rate bonds. We'll go into all of these in the course. You're familiar with this from corporate finance, of course. Callable bonds can be repurchased before their maturity date. If you feel interest rates are moving in a particular direction, you would either want to buy or sell a callable bond. Convertible bonds can be exchanged for the firm's common stock, so it converts from a loan into ownership of the company. So the debt holders can end up owning the company. Puttable bonds are a bond that gives an option to retire or extend the bond. So that's another option for loans. Floating rate bonds would simply have an adjustable coupon rate. So the like an adjustable rate mortgage would have an adjustable rate bond. And we also think a little bit about bonds as regarding preferred stock. So share characteristics of equity and fixed income are preferred stocks. The dividends are paid in perpetuity, which is sort of a never-ending bond. No non-payment of dividends does not mean bankruptcy. That is different than a bond. If you break your loan covenants, you absolutely have to pay the money back. And if you don't, you go into bankruptcy. And incidentally, if you never borrow money, you can't go into bankruptcy. Bankruptcy is 100% about whether you can pay back your debts or not. A company that is 100% equity finance can go out of business. It just can't go bankrupt. Preferred dividends are often paid before common. In fact, they're always paid before common. And there's no tax break on preferred stock. as they are with loan payments. So that gives you an overview of bonds and what we're going to talk about over the next few sessions here. This is a refresher for most of you that are taking corporate finance, so you should be able to breeze through this pretty quickly. There's not too much difference in investments versus corporate finance, so you should be able to move through this nicely.